Welcome to Taking the Biz, a channel designed to help A-level business students with their revision for their exams, and in this tutorial we're going to investigate the business ownership structure of public limited companies. So a PLC is a form of business ownership where the business is owned by shareholders. It's an incorporated business, which means just like a private limited company, the business has been through a process known as the incorporation process, which involves formally registering the business with the government. But the main distinction between LTDs and PLCs is how their shares are traded. In private limited companies, as the title suggests, shares can only be traded privately. Shareholders can only sell shares to people they know, people they come into contact with. In PLC, shares are traded differently. They are traded to the general public. Shares can be put on sale through a mechanism known as the stock exchange, and members of the public can buy a stake or a share of the ownership in this organisation. Now, in order to encourage members of the public to want to be owners of an organisation, they have to be rewarded with limited liability, because these people that buy shares don't actually get involved in the day-to-day running of the organisation. They're entitled to a vote at the annual general meeting, and they receive a share of the profit through their yearly dividend, but they're not actually involved in the day-to-day strategies and decision-making of the business. They might not even live in the same country that the business operates in. And in order to convince people to want to own a part of a business that they're not heavily involved in, they have to be given limited liability, so that if the business is declared bankrupt or is sued, then the business has to cover those losses out of its own assets and wealth, rather than the personal assets and wealth of its shareholders. So because PLCs sell shares to the public, they commonly have thousands or tens of thousands, some cases even hundreds of thousands of shareholders. And those shareholders aren't actually involved in the business on a day-to-day basis. Instead, they elect a board of directors that manage the business's day-to-day operations on their behalf. The shareholders have a vote at the annual general meeting where they choose from amongst them who they would like to elect to serve on the board of directors of this PLC. And it's the board of directors that develop the strategy and the vision of the organisation and manage it on the behalf of the thousands of other shareholders that aren't more actively involved in the business. So how does a business go about becoming a PLC? Well, it's not a quick process. It's not something a business decides upon and implements within a week or even a month. It's a lengthy process. It's a costly process. And it's a process that involves a little bit of expertise. So a business will appoint a bank that will guide it and advise it through the stock market flotation process. Now, this bank fulfills a couple of really important roles. The first is in promoting the sale of these shares to the public. The bank acts as a promoter, sending out literature to big investments, raising awareness that shares in this business will shortly be for sale. They will try and promote the sale of these shares to other big investors, maybe investment banks, pension funds, hedge funds, big investment companies, venture capital companies that make a living out of buying shares in organisations. But the bank fulfills another important role as well, and that is acting as guarantor. Because it's possible that at the end of the initial public offering, the business might not have been able to sell all of the shares that it thought it could to members of the public. And it doesn't want to have unsold shares. So the bank acts as a guarantor, promising to purchase any shares that are left unsold at the end of the initial public offering. Now, once the initial public offering is complete, the business now has thousands of shareholders all around the world. But these shareholders might decide, sometimes quite quickly, that they would like to sell the shares that they have bought. Well, there's a mechanism for them to do so, and it's known as a stock exchange. And a stock exchange is a place where the purchasers of shares are able to sell them to other members of the public. Now, a common mistake that students often make is that they think that the business benefits from the sale of shares on the stock exchange. They don't. The business has already sold shares. It's the member of public that bought those shares that then trades them on that actually benefits from selling them on the stock exchange. And what people will commonly do is that they wait for the shares that they've purchased to appreciate in value And once the shares are worth more than they've paid for them, then they might sell them to somebody else. And that somebody else will purchase them. They might receive a dividend over the course of a few years from the business. And once those shares have appreciated some more, then they will trade them on to somewhere else. So it's the stock exchange that acts as this mechanism for people that have bought shares that no longer want to hold them to be able to sell them to other members of the public. Now, becoming a PLC has some pretty distinct advantages for the organisation. The first is the huge amounts of capital that can be raised. Through selling shares to tens of thousands or hundreds of thousands of people, it can raise hundreds of millions or potentially even billions of pounds worth of capital. And this is capital that the business can use to finance growth and expansion and improve the profits of the organisation. But the other benefit of becoming a PLC is that PLCs receive much greater media exposure. They're seen as more prestigious, reputable companies. Media want to report on these businesses. Consumers want to purchase from these businesses. Suppliers want to do business with these organisations. So becoming a PLC has a prestige attached to it that might be useful for the organisation. But there are definitely drawbacks to becoming a PLC. The first is that PLCs can be a little bit more volatile. The price of a share in this business is listed daily in media sources. People track it, people report on it. And a business is very vulnerable to the fluctuations in its share price. If a share price suddenly drops, then the business might be seen as a more risky investment. It might harm the business's fortunes. So being a PLC, you are open to the volatility of changes in your share price. You've also got the problem that the directors of the organisation are no longer accountable to a handful or a couple of dozen different shareholders. Now they are accountable to tens of thousands or hundreds of thousands of shareholders, each with their own stake in the organisation, some of them with enough shares to make them pretty powerful voices in the organisation. And it can be quite a complex balancing act, trying to make sure that the needs of all of these different shareholders are met and accounted for. The other thing to be cautious about when becoming a PLC is that PLCs are subject to much greater media scrutiny. Now, when things are going well, this can be a great promotional tool for the organisation, but it also means that from a corporate social responsibility or a public relations point of view, PLCs are also widely reported on, and any errors or any scandals that the business is involved in might raise a lot of negative publicity for the organisation. Now, a possible question we should possibly be ready for that the examiner could ask on PLCs is whether becoming a PLC is in a business's interest. A common exam question is for the examiner to ask students whether the directors of an LTD would benefit from turning the business into a public limited company. Is this something that the business should look to do, or would the business be better trying to continue to operate as a private limited company? So it's definitely worth, during your revision of PLCs, having a think about this possible question. But there is the topic of public limited companies for you. Hopefully that video helps you revise it, and we're going to see you very soon for some more tutorials. And in the meantime, you keep on taking the biz.